Let's take a look at the real estate mixed-use acquisition model from Tilt Analytics. Mixed use in this case meaning commercial and residential segments. Acquisition meaning you are buying an asset that already exists and is operating. This is a very powerful tool, very robust, and a couple things that it can do that a lot of other tools can't is you can also develop onto an asset that exists. You can add a development portion. You can also exit out of these segments individually at different times. First we're going to look at the output sheets, and then we're going to look at the input sheets. My goal in building this model was to create output sheets that were professional and present well, and also build input sheets that are clearly organized and easy to follow. So on the cover page here, this would be your company logo, not mine, the name of the project. The table of contents is fully hyperlinked. I can click on the first deal summary. This model actually has two different deal summaries, as clients tend to like to see different information, and I'm happy to customize one for you as well. You see here property information, uses, sources, equity, performance, debt service coverage ratio in each year, and so forth. This one has cash flow from operations, non-operating cash flow, and other important things. Nice, appealing visual graphic dashboard. There's two different sheets on the investor return summaries, just to look at it different ways. You can have summary returns, the Lpgp agreement, cash flows in each year. You also have a hypothetical investment, so you can talk to potential LPs and say, what if they put in X amount of dollars, and you can see returns based on that figure. The other LP cash flow look, equity in, fees, pref return, return of capital distributions in each year. A chart of the cumulative LP cash flow. This cash summary is one of my favorite sheets. It's your entire project in one look. You have your cash in green over all of your cash out. I can see the information annually. Scroll to the right, see it quarterly. Scroll to the right further and I can see it monthly. Similarly with the uses and sources, I can see those annually or monthly. This summary analysis is useful in the sense that the project inherently needs to throw off enough cash to adequately provide profit for the providers of debt and equity capital. That's what this sheet focuses on. You have a unit summary on the commercial side. You have a sheet showing potential rents in each year. You have a summary P&L for the commercial. You also have a detailed P&L where you can see all of the potential revenue, losses due to vacancy, triple net, so forth, tenant by tenant. You also have a visual page showing the rent roll status of each of your tenants on the commercial side, whether there's an active tenant, with downtime in between, which rent roll you're in, and so forth. Similarly, you have tenants and P&Ls for the residential side. You have a return summary on the residential renovation to show the increase in value that the renovation has resulted in and relative to your renovation cost. Cash flow from operations, residential, commercial, debt service, TIs, asset management fees, and so forth, with some summary metrics at the bottom. You also have non-operating cash flows, getting down to the cash available for distributions to investors. A debt amortization table. You can have an acquisition loan and up to 2 refinance loans. Details on the equity Lpgp agreement. More details on the LP and GPs. You can have up to 6 different individual LPs in the model, or 3 individual GPs, and you can see returns for each person or company individually. A summary table here showing calculations for the waterfall. You also have a break-even chart on the cash, NOI versus debt service, and what you see here, the declining debt service here in NOI is a result of the model selling off units at different times. We'll take a look at that in a moment. Total cash flow in the project chart, Lpgp returns, an NPV table, Mezz returns, sensitivities. This is a two-way sensitivity table on the residential side showing what if exit cap rates are different than you think, compared to what if rents are different than what you think. And lastly, sheets on the GP cash flows. So all the inputs are on one sheet, cleverly called the inputs sheet. The input cells are all blue highlight with a deep blue font, and all of the inputs are categorized by section, and all of them are hyperlinked over here in column D. So you tell the model about the property information, the date of acquisition, what's the cost to acquire, and you can have different acquisition costs for the commercial and residential side if you want to. Closing costs on the acquisition. We tell the model about what are your commercial units, what are your residential units. On the commercial side, you have tenant-by-tenant rent roll flips, and so you can say it's currently occupied, there's an active tenant, they are triple net, and their lease ends in June of 2021. You're going to have 1 month of downtime. They're going to have $5 a square in TIs. You're going to have no TI downtime for that, and the acquisition loan is going to contribute towards the cost of the renovation. And after that, you're looking at the new tenant in the next rent roll. Their term is going to be 36 months, no rent abatement. They're also going to be triple net. So you see that you have tenant by tenant. You can have all kinds of options. You triple net. You can also do double net or nothing at all. You can also tell the model that the space is currently vacant. If it's vacant, it can be vacant because it's empty space that currently exists, or it's vacant because it's a future development, and the model will understand that and lease up tenants once the property is developed. You can also go on to populate rent rolls beyond the first roll, market leasing assumptions. Here are your rents on your active tenants. You have options on how to input. You can do per square foot per month, per square foot per year, per unit, and so forth. You can also do different step-ups on the rents. You could do, say, 5% every 2 years or something if you like, and you can input those figures here. Or you could do irregular increases and just input the date of the increase and the new rent at that date. And you can do that 3 different times. And you can do the same thing for the next tenant in the rent roll. You also have different ways of looking at the broker leasing commissions. Do percent of leases based on the lease term. You could also do dollars per square foot if you prefer. You can also have commercial renovations that are not TIs. They're not tied to rent roll at all. They're just renovations that you're going to do. And you can tell the model whether these are capital expenditure improvements or operating expenses, whether the acquisition loan will contribute toward them, when do they start. You can also have renovations that are not linked to a particular tenant, such as a parking lot. A few different inputs here for the particular expenses. Similarly, you can do renovations on the residential side. You can input your residential rents, and here too you can have rents that are linked to completing renovations, so the model knows when to do the step-ups automatically, or you can input individual dates. This can be useful for if you acquire an asset that is currently charging below market rate and you're going to take it up. You can also do other revenues. So for example, a pet fee might be paid by 25% of the units at $100 a unit. You've got year-by-year inputs for vacancy, concessions, bad debt separately for both commercial and residential. Operating expenses here too. The model's smart, gives you drop-down options for how do you want to input the expense per unit, per square foot, per year, a percent of rents, and some other options. Also, whether the expense is considered covered under triple net or not. And here you can, on the commercial side, you can sell the individual units at different times. You see here I'm selling 1 year after another. Also have closing costs, brokerage commission table. On the commercial exit, you can value each unit differently with different cap rates based on forward or trailing 12-month or you can just do a dollar input, and you can base it on dollars per square foot, dollars per unit, dollars in total. And if you're going to be exiting out over time, you have to think about telling the model how much of that money available from the proceeds of the exit are you going to use to pay down outstanding debt at that time. And so the model can handle all that. You have exit on the residential, different ways of valuing. In the acquisition loan, you can have different percentages on the amount of coverage for the acquisition cost compared to the renovation cost. You've got 4 different GP fees functional here. You got acquisition fee, capital placement fee, asset management fee, disposition fee, if you care to use those. A nice summary table here showing the your revenues, expenses, NOI, debt service coverage ratio in each year, net cash, and so forth. The model will warn you if your NOI can't cover your debt service. Here's your last part of inputs is the Lpgp agreement, the preferred return distributions. You can do your pref. The GP can get a pref also if you like. LP can get paid back first or simultaneously. You can do a waterfall here based on IRR hurdles, or alternatively you could just select to do fixed percent distributions. This waterfall goes to sleep, this part comes alive. And then lastly, you can tell the model individual names of investors, and the model can even handle equity recognition for non-cash contributions of investors as well. And so once you've come that far, you're at the end, and I'm happy to talk more about the model with you. Feel free to give me an email at tiltanalytics@gmail.com. The website, of course, is tiltanalytics.com, and thank you.